So welcome to the Early Pay Partnership Series. This is episode number 4. My name is Donelle Brooks and I'm the National Partnerships Manager for Early Pay. And I'm thrilled to be able to bring this partnership series to you over the coming months, where we're really going to tackle some of the issues. We're going to look at some of the insights that are happening in the market from all of our partners. So whether that's in accountancy, insolvency, business advisory, we certainly know with the economic climate as it is that we have many clients who have got huge potential and opportunity for growth. And we also know that we have clients who have really strong businesses who are finding themselves in a tough situation. And that leads us to today's webinar with the wonderful team from WCT Advisory. And I would like to welcome Matt Flowers and Andrew Weatherley to our webinar. Welcome, men.
Morning, everyone.
Morning, everybody. Great to be here.
Thank you so much for joining us. We often hear at the moment a lot of doom and gloom for a lot of businesses in the industry, and quite often, engaging the services of someone like yourselves and WCT, there are options out there for businesses that are finding themselves in a difficult situation. And we really wanted to put ourselves today in the position of the broker who has that client who rocks up to them with a really difficult situation. And we know that sometimes brokers are unsure or may feel like because there's no mainstream funding solutions available, that they can't help that client. So we're going to tackle 6 pretty in-depth questions today. And we really recommend and really encourage you as our audience today to please use the chat functionality to ask any questions. We are allowing some time at the end of this because we feel as though there may be a few scenarios or some pointed questions that you would like to ask both Matt and Andrew. So first of all, I'm going to kick off with you, Andrew. Quite often we'll have, a broker will have a client that turns up and, they've fallen over, they've entered into liquidation, they may have had a major debtor fall over themselves. Sometimes it's even that they've lost a major contract with a customer. So when you've got someone who's in that process of beginning to fall over, what are the first sort of steps that you would take and what do you encourage brokers to do?
Well, we usually look at trying to understand the situation a little more, and particularly probably the impact of, say, that major customer or that major debtor going to liquidation or voluntary administration, or that a contract's been cancelled for some other reason. Matt and I had a business late last year that came to see us who developed sort of apps and digital platforms for several parties, including some governments. And they had this exact situation where they had a client they were doing some work with, didn't pay them over 3 or 4 months, would have incurred about 410 grand of debt back to the company. They got to the point that they realised that was no longer continued. Those amounts weren't going to be recovered, and kind of got in this position of what do they do? So they spoke to a broker who, I suppose, luckily enough for and them, we had a relationship, and they contacted us and kind of said, here, what do we do? So this is something that happens quite a lot. The first steps that we looked at is just trying to understand the impact of, say, that customer not paying, and for them 410 is quite a large amount. What does that do to cash flow? What does that do to business viability? And the first step is really to prepare a bit of a base cash flow forecast if the company doesn't have one already. What does that look like right now? And then looking at, pulling out, for example, if that debtor usually pays monthly, next month you've got to pull that out of your cash flow. What does that look like? In this instance, this was should have been an ongoing contract. So the impact also was then felt of kind of that ongoing future revenue. And so you start pulling out those figures and understanding the impact to the bottom sort of line. It really helps you get a grasp of probably I suppose more around the challenges that you're going to face, but also will assist with kind of develop some of the strategies that maybe you can work with. With the loss of a contract or sort of a non-payment, often there's other things to think about that are going to impact sort of the viability of that business and the cash flow that's there, but also what sort of might be required. For example, if you've got staff working on a particular project, all of a sudden you've got 5 or 6 or more staff who I suppose, aren't able to be deployed to that particular project, have you got something else for them to be doing? You know, you're paying 6 people. If you're paying your wages weekly, that's going to become a bit of a challenge. And some businesses, depending on the industry, you know, you might be renting a shed nearby a job site, for example, to store gear. Well, again, you've got an ongoing fixed cost for that shed. There's different things that you need to be analysed as part of preparing that cash flow forecast. And I suppose that will then highlight to you, say, some gaps. So it may not be this month, for example, but you know, in 2 or 3 months, and often what we find is when it comes down to, say, a quarterly BAS payments due, that at that point, you know, you've got, and depending on sort of months involved, you've got a BAS payment, you've got superannuation due, you know, you can get some fairly large statutory kind of liabilities that come due in those months, and that might be a couple of months down the track. So if you can identify when that shortfall is going to occur, start then trying to plan, you know, what the solution might look like, what are the strategies that you can implement, how do you push that out, lessen the impact, all of those kind of things will come to head.
Yeah, absolutely. And it's interesting too, Andrew, that you talk there about looking at what is, you know, urgent, what's the burning platform for the client now, what are their obligations that they have right now, what are the obligations that they can move forward into the future by utilising people that can help negotiate those arrangements or help negotiate, you know, that delayed payment as well.
Yeah, absolutely. And I think you find, you know, it sort of depends on your industry and your history with suppliers, but you often can look at, you know, can you enter repayment arrangements? You know, the ATO is a prime example of that. But sometimes we also get part of that's looking at short-term sort of funding solutions, you know, and sometimes you just need some funds to buy you enough time for your other strategies to take. You know, you're looking at, you know, can you get some debtor financing possibly if you haven't had it previously? Have you got unencumbered equipment that maybe you could get equipment finance over, which is going to give you a bit of a cash injection? You know, can you get a temporary overdraft or an increase of your overdraft limit? All of the sort of relatively short-term options, you know, should be assessed, because what you're trying to do and push it out, and hopefully allowing other strategies like, I don't know, the sale of assets, for example, or the owner to kick in some money, you know, other sort of profit improvement kind of strategies as well.
Sure. It's interesting actually, because Maddie, this might be a good lead into you, because, you know, Andrew just spoke then about, you know, directors being able to, you know, tip in some personal funds if required. But what we often find, and certainly what I've heard in my experience, is especially in liquidation, you know, often they want to have a look at borrowing, you know, can they borrow to buy some of the assets back from the company? Now, that can sometimes be an asset that they use in their personal life. So whether it's vehicles, you know, but quite often liquidation may lead to a new business structure down the path. So they do want to retain those assets. So how does borrowing back as an owner or a director of a company that's in liquidation, how does that work? What are some of the pitfalls and what are the ways to get around it?
Yeah, very, very common question, Donelle. And I suppose really what it comes down to is, you know, what are the circumstances, you know, for the director personally, you know, how long has the company been in liquidation for? But I suppose realistically, as a starting point, the first question is usually, you know, what is the value of that particular asset, you know, versus, you know, and worth basically what the payer figure is, right? So really, what is the equity position in a particular asset? That's going to often determine whether, you know, a director can actually, or a related party can actually obtain funding to go and buy the asset off the liquidator. And look, that's no different to, I suppose, you know, if a company's not in liquidation. So there are some similar similarities and similar things you need to think about when going down that particular path. But in terms of liquidation issues, look, it's going to affect the director personally if they're looking at ones who are going to try to borrow the funds. You know, because obviously on the credit will go on their credit record that they're a director of a company in liquidation or external administration more generally, at least for the duration of, I suppose, that particular administration, which can take go for 3-4 months, or it could go for years in some instances, right? So, so that's, I suppose, the first consideration is who's borrowing the money, or who needs to borrow the money to I suppose, buy the asset. I suppose a vehicle is a good, I suppose, example of that. And look, the options will be limited. You know, I suppose in a liquidation scenario, in terms of who you can borrow the money from, so what lenders play in that space and things like that. I suppose the next thing is also, what if there's a shortfall? I suppose that's the next question, because I'm talking about a situation where, you know, once you've made the assessment as to the equity, you know, is there a shortfall, right? And the finance options are generally, you know, as I said, are limited, probably more limited in that particular situation, meaning the client's got some of their own cash to chuck into the to the deal, or you know, or it might be more of a discussion with the lender, because in liquidation, some lenders, no matter what the situation, right, whether it's there is a shortfall or there's a surplus, they've got certain policies, which I said the brokers out there are probably more familiar, just if not more familiar than myself in that regard, whereby it doesn't matter, companies in liquidation, they won't either refinance, even if there is equity. They just want their money back, and often they'll give you sort of 30 days or something like that. So they'll give you a short notice and things like that, notices of default, and they'll give you an opportunity to negotiate that. But quite often, there are a number of lenders out there that you know, very much cut and dry, black and white, you know, non-negotiable. That's just it. I'll give you enough time to get out, but I don't want you as a customer anymore, right? So
yeah, sure.
Particularly some of the restructuring strategies that we look at, you know, that becomes a consideration of, could you assign a lease agreement, and maybe the agreement provides for it, but certain banks just don't want to borrow it. But you know, having that in mind, sometimes it does come up. You've got to find a refinance. It's got to be a payout to them to get rid of them.
Yeah, exactly.
Yeah, I think, Maddie, just to interrupt there too, I think, you know, one of the things that is interesting, and you mentioned it, is that when you, you know, are in external administration or liquidation as a director, that is on your credit file. So, you know, is it quite often that they, you know, they do struggle to obtain, obviously mainstream, we know that, but have you guys been involved in anything where you have been able to access finance for a director to sort of get them out? You know, they're a good business, and like the first question we asked, it's been no fault of their own that they've fallen over. What sort of, you know, obviously we know what we do at Early Pay, but are there other funders out there that can really help directors who have got this mark on their credit file?
Yeah, look, there is a lot of lenders out there, more recent times. As I said, over the years, as this is a big part of the Early Pay success story, is that, yeah, the mainstream lenders are, you know, they're very rigid in the way they do things. So, you know, over the last few years, there has been a bit of a growth in that space, whether it's fintech companies or just, you know, sort of private lenders, whatever the case may be. So yeah, there's a lot more options these days than there ever has been, in my opinion. What I do find is it's some of the, I suppose, been finding in recent times that there's more lenders in that that sort of want to be in a niche space. So they either just want to do debtor finance, or only do specific invoices, or they want to do equipment only, or even more niche, they only want to do yellow goods, for example, right? So so look, there are definitely options out there for directors to, I suppose, be able to salvage any assets, or even, you know, as I said, you know, deal with an issue that I've got personally when it comes to the company that's gone into liquidation, where there is a secured lender in there with an overdraft facility or something like that, so you get them out of that particular situation. So look, there are a lot more lenders out there, a lot more lenient, so I suppose, to or be willing to borrow. What it comes down to is the business itself, and what's the business case, what's the reason, like you touched on, for the failure. You know, is it oftentimes not part of necessarily their fault. The key is to make sure they're not going to make that same mistake, which is part of our assistance, right? And then the idea is to sort of give the broker comfort and the lender comfort that, look, this business makes money, or it's got the ability to make money. We don't sort of touch too much on the past, because really we're at the future when you're trying to get a loan, right? So, and you need to sort of think about what happened in the past, but you really need to focus on that. So a lot of it comes down to, in that space, is a little bit different to your mainstream lenders. They're not just ticking boxes. They're looking at, okay, is this a fundamentally good business? And what will usually happen is that they will factor in the risk. So obviously you might be paying a little bit higher interest rate, but they've got an appetite because they've had experience, I suppose, doing that. And or the other way they'll de-risk themselves, that the LVR might be a little bit lower, so they might not lend 80, 90, they might only lend 50, 60%, and you might have to chuck some cash in yourself, or whatever the case may be, right? So yeah, so there are definitely, so recapping on that question, yeah, there are definitely options that are available, and it's definitely doable. There's just, again, it comes down to the particular situation the client faces themselves in.
And that's why I think it's so important. Sorry, Andrew. That's why I think it's so important for our brokers to understand, you know, what you guys do in the space, what WCT do, and obviously there's other people in the space just like us. But you know, it's really important for brokers to know that it's not the end game when you have a really distressed business, pick up the phone and ring you or send in an email inquiry. It's about knowing who the right people are to work with the industry and leveraging and building those relationships, because a client that you assist save and take them into a new, stronger business is a client for life.
Just to touch on that quickly, to recap on that, sorry, before I forget the line of thought. The actual structure moving forward. So who is going to be the borrower? So I've led to all those issues about that you might have as being a director or a latter party. Really important if you're trying to apply for finance. When there has been some legacy issues, we'll call it. Who the borrower is going to be moving forward, who the guarantor is going to be forward. Whether it's a company, it's a company's trustee of a trust, is it an individual? Because lenders are becoming more savvy in that regard as well. That's one thing about they're quite often in space. Certainly, they'll do a lot more checks and balances around that sort of stuff. And as soon as they find out, oh, you've had a company liquidation, and so I suppose it's important to structure right, but it's also important to be transparent as well, right? Because the last thing you want to do is find yourself in a situation where you're trying to, I've only got this way to do it, but and it might become too late. If you had those discussions and a little bit transparent, the broker might be able to get a lender that will actually work with you, as opposed to going too far down one path and then going, oh, geez, I wish you told me that. So a bit of research as well from a broker's perspective as well would also help, which you may not necessarily need to do as many checks and balances in a normal scenario, but it might be, and we can sort of help with that as well. But given the background, things like that, just being across that and what the new structure might need to look like to make sure you get the best possible chance of, I suppose, getting that loan.
I think the key there is, Maddie, is that, when you do have a client in this situation, that you're not looking to polish anything up or make anything appear as if it's not, and being really honest and transparent is really key. And Andrew, that probably leads in again, from what Maddie was saying about making sure the structure's right moving forward to be able to obtain finance for these type of businesses. What happens though when you've actually got a director or shareholder dispute? So what are some of the things that you face and some of the challenges there that our brokers need to be aware of when the dispute sits within the structure of the business?
Yeah, it certainly complicates things. The key thing to understand when there's a dispute, to try and get your head around pretty quickly, is who's sort of in control, and I guess depends on shareholder split and how many directors are, etc. But how is that business operating while the dispute's going on? And we've seen instances where we've had a two-director company and one director actually has been locked out of the premises and prevented from going into the business. How is it operating? Who's got control of bank accounts? Because those kind of things can very quickly turn a successful business, but if parties can't agree, for example, to make a payment towards certain liabilities or something like that, can quickly bring a business into almost being an insolvent position. So we understand sort of what's going there and work out some options to make sure the biz can continue trade. Then again, you can kind of step back to that, doing a bit of an assessment of its viability, its forecasts, and what your options are. And I think understanding whether is it this sort of as a result of the company's viability or profitability or lack thereof, or is there some other reason that there's a dispute between the parties and the business is otherwise viable? Because if you've got a viable business, then you open up your options about trying to get a sale away, or one of the parties buying out the other one. And all of those are going to require some kind of finance, particularly if you've got one, say, business partner or shareholder wanting the other one. one of the things a potential incoming lender is going to look at is that viability. Has it got the capacity to make the payments that are required? What's the asset values? How much they're paying for. Things are sort of, I guess, a function that a lender is going to look at. But having a dispute is a not uncommon scenario, particularly where, say you've had a business that was successful, something happened, and now it's on this sort of slide. It really generates a lot of stress, a lot of tension, and people handle those in different ways.
Absolutely. I guess it's all about having the evidence, and again, back to Maddie's point, about getting the story and not hiding anything, and really being able to understand why that dispute has occurred. And I think something that you mentioned, which really, when we first spoke about this a couple of weeks ago, was about who's controlling the bank accounts. To me, it's not something that I think of when we start talking about this space, but it's so important to make sure that is almost one of the first things that the broker says is who's in charge of your bank accounts. Get that sorted first. It feels as though that can be where it can even get worse from, whatever's caused the dispute in the first place. But then, you've got random access to funds. It feels like that's sort of one of the first steps.
Yeah, and this, a lot of what we look at, particularly in some of our advisory roles, is sort of some of the practical aspects of these situations. I've dealt with, we were advising a law firm, and they were acting for the husband and wife were both directors, 50% shareholders. They had separated, and the problem was the level of conflict between the two of them meant that business couldn't operate because they were both signatories to the account, so both of them had to give approval. And you always found that one would say, yep, happy to make that payment for whatever it might be. The other one would say no, as a matter of course. And very quickly, that one sort of got down to the point that suppliers were issuing demand letters. There was issues around, it got to, and this was over several months, that they were talking about, Telstra cutting off the phone. And all of those would just totally kill that business. And I think, luckily enough, the lawyers managed to get them both on the same page and agree. Genuine business transactions should be approved, and they set up a mechanism for that to occur, which effectively sort of saved that business. But that wasn't what the dispute was around. The dispute was around, their husband separated. This business was sort of stuck in the middle.
We see that, more and more. Yes, we're seeing, the effects of COVID and the long effect of COVID on businesses, especially in that real B2C space. And then we don't realise and understand all the supply issues to all the businesses that supply them, but also life events happen, right? So you're right. You use this example of separation, medical health issues. There's lots of reasons that can lead to these sorts of disputes, right?
And we've had ones where it's not even necessarily a dispute. You face the same issues where you say have a director, might be a sole director, who falls ill. We had one where he'd had a heart attack, able to manage the business. The family thought, well, we'll step in and we'll kind of take control and make sure this business is okay. But when they got in there and realized that, it was borderline insolvency, they had quite a lot of liabilities that were falling due soon. So no one wanted to become a director even for a short period of time because they're worried about putting themselves into it. And these are the kind of things that happen. So a lot of the stuff we talk about being there a dispute even just might fall back to, well, what happens if you don't have a director? And no one's willing to put their hand up and step into that position? What are the things that you do? And again, a lot of that comes down to that assessment of viability and what a cash flow forecast looks like, for example.
Yeah, perfect. Hey, Maddie, we did the first webinar in our series was with Olga from Tax Assure. And so a lot of that conversation was around, DPNs and seeing lots of, default notices and, director notices. What's your first, or, you might have a top 5, top 3, but when someone has received that sort of legal claim or correspondence around any of those things, a statement of claim or, a statutory demand, even a winding up application, what are your tips for the brokers out there when they've got a client who goes, I've received this notice, what do I do?
Oh, yeah, it's very, very questionable. I mean, I think you've recited all the key ones there in terms of the different types of claims. Because the director's penalty notice is the most obvious one, and the tax man's always at the top of the tree. But I suppose the key is to, I suppose dealing with it ASAP. Without sounding like a broken record, everyone says get early advice. Well, it's true, right? So getting on as soon as possible, talking to the client, asking the client, have they got a plan for dealing with that particular issue? So I suppose from the broker's perspective, it's just having a discussion with the client about, look, are there other issues even, right? Because sometimes that's the second thing is you got one issue. Quite often there's probably a second issue as well, right? So it's about opening that discussion with the client and saying, well, look, and oftentimes that discussion will depend on or end up resulting in either one or two things. First thing, okay, that's your only issue, right? We can go and deal with this. We can negotiate it out. We can go get some finance. We can work with Olga, whatever the case may be, in the negotiation sense. Or no, there's some other issues. There's some more fundamental issues. So it's really having that discussion with the client to understand their business, right? Because understanding your client's business helps them, I suppose, sort of work out where their best fit is with a lender, and prove the success of actually getting that across the line. So really, it's just having that discussion. Really, it's all. That's my advice.
And in your sort of history and with your expertise in this industry, Matt, do you find typically that there's something else that is going on? Is a director penalty notice, or is that often reflective of something else going wrong in the business? Because we often hear that great businesses, especially in their infancy, are piling all their money back into the business. And get to tax time and really haven't had their finger on the pulse and have got no idea how much money they've earned, and then they're whopped with this massive bill that they haven't really planned for, but they've been reinvesting back in the business. You know what I mean? So talk to us a little bit about that.
Oh, look, absolutely. I wouldn't say every single situation, but quite often there is more than just that tax debt issue, right? So usually there's a fundamental, I suppose, reason for that, right? Tax debt doesn't crystallise just because it crystallises it. There's usually a reason for it. So, and look, there's often multiple different reasons for that. So it's usually a fundamental issue in the business whereby, there's a drop in revenue, or, the overheads are way too high, or, directors have stepped away from the business. And that's another good one where the directors think the business is going well. The first thing sometimes they'll do if they haven't had a holiday in a while is to take a step back and let somebody else run it. Then they find there's issues, and it becomes a bit of a spiral. So look, there is always, I suppose, in my line of work, in terms of inquiries we get, there are situations where, it's just the tax debt situation, but quite often there are a number of different reasons. And as Andrew touched on earlier, it's about understanding the viability of the business and looking at cash flows and understanding what those issues are, because numbers don't lie, right? They might not necessarily tell you the whole story, but at least they're a starting point of discussion and talk about the numbers. And that might then lead to, I suppose, understanding what the other issues are. But just touching on the tax side of things, I said a good example, and there was more than one issue in this particular situation. It's a client who had a lot of equipment and a lot of gear, and they said fundamentally the business made money, but the issue was he'd go out and go to the auctions, and any money he made, like you said, he reinvested back in the business, and was very much, I suppose, using the cash and the profit to buy new gear, but fun. And yes, he only had only very little amount of finance, right? Because he'd gone and paid all cash for all this stuff. But it got to the situation where he's got this letter in the mail from the tax office saying, it's $700,000, and he's like, didn't understand why this situation had crystallised. And it was very, very simple. He'd just been, rather than sort of monitor and keep track of values, just out there buying stuff that he liked the look of. So, and yes, that equipment a lot of the time would help make money, but it just wasn't working. So in that particular situation, as I said, it became the accountant thought the company needed to go into liquidation, because the ATO had actually already issued not just a demand letter, they'd also issued a winding up application. So this client was faced with a situation where we go, what do we do? And I looked at the gear. There was so much equity in this equipment. That was one positive. There was so much equity in that gear that there was a funding solution for that, right? So, and it's just that no one had thought about how to approach that, how to deal with that, right? So then it became a situation of, okay, well, let's get an adjournment of the ATO hearing, or the wind up, and let's buy us some time to go and actually try and figure out what we can do. And in that client situation, yeah, he avoided liquidation because, you know, through with the assistance of the broker and the lender, just had to work through a situation to sort of find, do a combination of things. So there was a combination of equipment lending and there was a combination of debtor finance, right? So, and it was more of a, okay, let's leverage off the gear that we've got and go through that process. And buying time was to allow that to happen. So, but again, that was the fundamental issue, was he was buying too much stuff and things like that. That was really the crux of the issue, right? So it wasn't the usual thing you think, oh, there's property issues, this now, just literally just buying too much crap. So.
Yeah. And it's interesting to hear that something that business owner would think was so, such a positive situation, that one, he can pay cash, two, he's building his assets in the business. But then thirdly, it was creating this huge liability for him, which I find really, really interesting. Something that's resonating through all of this already, which, we always encourage our brokers to chat about, and certainly for us in the niche space of debtor, it's really important. But I'm hearing it from you guys as well, is numbers tell the story, but you need to ask the questions about the numbers. You really need to get into these clients and really have a true understanding on what's going on, and giving them the comfort that they can trust you, that you're going to have difficult conversations. There's going to be things that they may not want to admit as part of these conversations, but to really understand if there's a solution out there, whether they need to engage the services of someone like yourselves at WCT. It's really about asking questions so that you've got the story that sits behind the numbers that are outputting from that story. But Maddie, I'm going to stay with you for a second, because one of the other things that we hear about, and it's funny, because the word Phoenix often blows up in our industry from time to time, and I'll let you chat about that. But what happens when you've got a client who's looking to set up a new entity to transfer the business or the assets as part of like an internal restructure? Now, when we say internal restructure, we know that that's obviously being done correctly. So I'm happy for you to touch on, Phoenix and what that means for sort of some of our new brokers that are on here today. But what should a broker do when they've got someone in that situation who's looking to do that?
Well, I suppose the first port of call without is to basically get advice. It doesn't matter who it is. It can be us, someone who specialises in providing advice to company directors and and understands business, right? So getting some of that advice around, okay, well, what is the, and I suppose, what is the reason for the restructure, right? That's probably the first thing, is to get advice. But in terms of what advice you need, often at times it depends on who you go to, depends on what the actual reason for the restructure is. Because I know you mentioned the word Phoenix in an assumption there, but sometimes it can be an internal restructure where it's a genuine restructure, right? For not nothing to do with the fact that the business isn't making money or needs to tidy up some legacy debt or anything like that. It's a genuine restructure for whatever the reason, right? So, I suppose, so once you understand that, getting the right advice on the right person, then it really comes down to understanding what is it. So once you know the reason for the restructure, and actually I'll just touch on a couple of reasons for a restructure where it's not, because everyone knows about the business is broke. Some of the reasons why it might be a restructure where the business is fine is, for tax planning reasons or licensing reasons or asset protection reasons for a rainy day, whatever the case may be. And particularly in Queensland, I know that in the last few years, there's been a bit more of this in the construction industry. QBC, when it comes to the regulator and having a license to run a construction business, but the preference is that it's a company that's running the business. There's a lot of companies out there, construction industry, where they're still set up as a company as trustee of a trust, and it's a whole lot of extra effort and work for the regulator and also the accountants involved and things like that. So that's a genuine reason for a restructure, to sort of, because it saves them money and compliance costs and gives a bit more line of sight around the business itself and to the QBCC and that sort of thing. So there can be a variety of different reasons. I just want to touch on some of the reasons you might come across where it's a restructure for a reason other than they just need to reorganise for tax benefits, tax planning, asset protection, whatever the case may be, right? So, but I suppose touching on the, the transfer of assets to a business where There is some solvency concerns. But the first thing we'll look at is the viability of the business, as Andrew's touched on a couple of times, very critical. Right? Without sounding like a broken record, that is absolutely key to understand whether the business actually makes money. Because particularly, I suppose, our approach to things is we're not going to sit there and, advise someone to restructure a business in that situation where the business just doesn't make money, right? So I suppose the one constraint that we sometimes have is timing, right? So again, early advice is key, because the less time you have, the less time you've got to investigate things, to work out, is it the right call to actually restructure the business, right? So, because that's not helpful for the client. If it turns out that was the wrong decision, it's not helpful for the finance companies involved if they've got to go in and actually do something after the restructure is done. If there's issues with the liquidator, whatever the case may be, right? So really, I suppose that's a very critical part of the process that we look at. And the others, I suppose, other than the viability side of things, the things that we'll look at are what I sort of call practical considerations, right? So that might impact the transfer of a business. And look, all these sort of things lead to, I suppose, a broker being in a position whereby they've had advice, all the issues have been dealt with in terms of the viability of business, any practical issues that might affect timing, because a lot of the time these practical issues, we'll touch on in a minute, they can be achieved and dealt with, but there may not be enough time, right? So that then affects the broker and who they go to, how long the loan approval will last for, and things like that. That can often affect, so they've got to get the timing right around that. So it's really key to get across as many of these practical issues as possible. So without getting into it too much, some of those sort of issues that we sort of come across generally are, needing consent from existing lenders, right? So you can't transfer a business without getting consent from existing lenders. Customers with contracts, good example is those with vendor numbers, particularly in the mining services space or the transport industry. That can sometimes takes, where a client not long ago in the transport industry, it's going to take 8 to 10 weeks, excuse me, to have the vendor number transferred to a new company. So that then led to, I suppose, a different strategy for the client in terms of putting into administration and working through that way, which worked out perfectly fine. But again, it's just understanding of these things and how long it might take to implement some of these things. So
yeah, sure. Hey, Manny, we have just had a question from one of our brokers actually, who's just going through our scholarship program at the moment, and he's asked the question straight out, so I'm going to let the expert answer it. What is a Phoenix company structure, and how would he identify it?
Oh, very good question. First thing I'll say is there's no definition, as I still understand it, around what a Phoenix actually is. There's some material on the ASIC's website about that, but effectively, on a broad brush, if someone's got a brand new company, they're wanting to get finance in a brand new company that's never traded before, that's the first thing to look for. And then I suppose from there, that should then trigger you to ask the question, okay, why are you asking the business? So why are you wanting to get finance and name a brand new company, right? And that will generally lead to finding out, okay, what the reasons are for, right? And I said, in terms of a Phoenix structure, well, generally, as I said, let's talk about, I suppose, the ones where that are done properly and legal. The client is wanting to transfer the business from one entity to another, right? So, and again, how that process folds out, I said, it depends on how I suppose, the expertise of the advisor involved and things like that. But in terms of an actual identifying a potential Phoenix, really, it's a transfer of business from one entity to another. And the best way to pick up on that is to just have those discussions with the client to understand why you're actually getting finance in the first place. But often the dead giveaway is it's a brand new company, right?
Yeah, sure. Yeah.
So
that makes a lot of sense.
So there's really that's probably the clever way of answering that question. That's just the obvious, right?
Yeah, perfect. No, that's good, and certainly, we do see it a little bit, not as often as before. I think it was probably a little bit more prevalent in, the early 2000s and 2010s, and we don't see as many. And I think you're right, there's a lot more legitimate reasons for restructures out there now that we're seeing, whether it's just, people that have owned the business for 40 or 50 years and are looking to exit, and we need a complete new restructure, new borrowing entities, new boards. But, clients are staying on, contracts are staying in place. So I think it's really important that, restructure is certainly not a dirty word in finance, and restructuring of a business is often for a really positive reason.
And the word finish is just thrown out loosely, in my opinion. It just gets, it's had a lot, it's like, a lot of publicity, but again, in my view, it's just a word. Right?
Yeah. I like it.
Really comes down to what's actually happened, right?
Again, drilling in and talking to the customer. Andrew, I'm going to come back to you for the last one before we go to questions, because we're sort of already at 45 minutes, which is great. Obviously early pay work in the alternate space, and certainly are not classed as a mainstream lender. But what happens when brokers are talking with clients who are in these situations that we've spoken about this morning, and they can't obtain finance from a traditional or mainstream lender? And, let's face it, there's lots of B2C businesses there. So I would sort of want you to cover both, from types of finance that you guys can access by being part of the advisory team to really see the business through the restructure or the buyout or whatever it may be. What sort of finance are you seeing across the spectrum? And why do you think it is that, these alternate guys are really having an appetite for these type of clients?
Well, I think sort of the first course is just to understand why, a finance application was rejected, or, often a broker will work that out before they actually put a finance application forward. But the reason, what are the challenges? Is it around asset value, so the value of security proposing? Is it the level of debt that you've got there, so your equity levels are fairly small? Is it, and what we're seeing a little bit more is more around that sort of business profitability, so your serviceability for the level of borrowings that you have, or alternatively the level of borrowings that you'd like to have. They seem the major ones, but sometimes it's just, there's a legal action going on, you've got a default. We've seen where sometimes a lender just doesn't, or wants to exit a client or an industry or a geographical area. So there are all sorts of reasons why. I actually just want to understand what that is. And then often it leads back to, and I have hopped on a little bit about it, is that kind of assessment of sort of viability and what a cash flow looks like. And one of the key considerations when you're doing that is just, you want to make sure that that business can afford the cost of sort of a second tier or sort of other alternative sort of lender, because often that comes with a higher cost. But we see recently, I think we've had success and probably is dealing with early pay. And I think some of this comes down to understanding the restructuring industry, understanding the reasons behind a restructure, and even if, and even take a slight step back to some of the stuff that Matt was talking about. There's an illegal Phoenix, and then there's a Phoenix which covers even a legitimate restructure or a transfer of assets. But we look at, sort of, I suppose, funding options might be, you got to boil down to what funding you're seeking and why. If it's equipment finance and you can't get, say, equipment finance from a main lender, what's the reason for that? Sometimes you'll find, I don't know, early pay, for example, to provide equipment finance. Sometimes it's a matter of a different financer will look at an asset differently and look at things overall.
The asset class is I'm finding the asset class is very important, I suppose, in terms of these lenders. I've touched on before about niche lenders only wanting to lend on either a certain gear or a certain age, or, because they've just found that, that it's better to focus on one thing and do it well, as opposed to let's just lend money against everything.
Yeah. And often your larger banks will have other criteria that they're going to put through, whereas, as Matt says, we come across recently someone who just deals with yellow gear. So for us, if you get a situation and you're in that particular industry and you're wanting to buy something, or alternatively you've got unencumbered gear, that becomes an option for us to go, well, hang on, let's go and talk to them first, because they're specifically looking at that gear. And they look at things like almost like a buy and say hire back kind of arrangement. So they'll pay you some cash for your asset, allow you to hire it back over a 2-year period, for example. And what they're looking at is where they're sort of getting, I suppose, their return is that they're confident they can take that piece of equipment at the end of those 2 years, for example, maybe recondition it and sell it and make some money on that front. So they're looking at income for a period of time, and then they think that they can get close to what they pay for it anyway through a recondition down the track.
And that's sort of, for the good example of that is, you know, if you've got a client who's won a contract and doesn't want the hassle of owning their own gear, just needs for 3 years, and that's a sort of can be a perfect solution for that, right? Plus, also may want the option of, you know, at the end of that, I suppose that 3 year period, even buy it if they want to, right?
Yeah.
So, and make it more cost effective than say hiring the gear, right? So there's some lenders out there. There's more than one. That's just one that Andrew mentioned. There are more that out there where that's the focus in terms of, well, we'll just make it more competitive than someone who's hiring equipment out, right? Plus, the client has a benefit of then, you know, being potentially to buy that asset, and there's obviously tax benefits around that as well, right? Yeah. So.
And Andrew, are you seeing lots of combinations sometimes when you get to this point where, you know, you do get an overdraft facility and there might be a little bit of EF in there and there might be a bit of debtor? Like, do you see a combination, or
often
what
is
are
a
lenders'
combination
appetites for that?
And because you can go to different lenders for different products. You know, we've dealt with a construction company recently that they were a long-term big bank client, and to the point that they'd paid off, you know, all their facilities and they had no current borrowings at that time. They went back into big bank land to look at getting an overdraft, and the answer was no, and they couldn't sort of work it out. And ultimately, they got down to the point that, but they could get an overdraft from sort of a smaller, you know, probably second-year sort of lender without that much trouble. And it was just a matter of that they didn't use a broker. I think they just went back to, you know, picked up the phone to the person they used to deal with at the big bank and said, hey, we need an overdraft. And they said, oh, well, hang on, we want to see all of these things because we haven't been involved for years. And it just became a problem. Whereas the other lender, they were able to get, you know, a lot easier. We've dealt with, and often these situations arise sort of for us where sometimes it's the financier that contacts us. And we've done a couple of times with early pay, which you may or may not be aware of, is, you know, where, you know, a current client who say got a data factoring facility, for example, has asked for an extension to that facility or some additional finance, you know, maybe some equipment finance, whatever it might have been. And there's been kind of a question mark whether it's a, you know, and the example I'm thinking of at the moment is, you know, that they had a fairly large ATO liability. So early pays hasn't necessarily said no, but it's kind of gone, well, what's the plan for dealing with that? Because whilst it doesn't necessarily impact, you know, say the current data factoring, it does put a question mark on the longevity of that relationship. And what does that look like? And so we sort of then had to work out, and again, it came down to that, being able to demonstrate the viability and a plan to deal with that liability, and then kind of go back to early pay and say, all right, well, here's what it is. We've been involved. We've provided advice. Here's the structure. Here's the recommendations that they implemented. And this makes sense for you to provide that funding.
Yeah, perfect. And look, we're seeing it too in the industry, and there's some other great lenders out there who, you know, will definitely listen to the story. We know that ATO debt does cause a high level of discomfort for a lot of lenders, and rightly so, if it's not managed. And that's the key, absolutely, is to not look at the size of the ATO debt. You know, one of our guys has just got a deal over the line, you know, with a $1.8 million tax debt, which is under arrangement, and, you know, they're paying 350 grand a month. That's a client, like, it's not to be scared of. It's about, you know, drilling in and finding out the answer to the question to then support your request for finance, right?
And if you can find, and I think it's, and we sort of touched on a couple of times, is just the level of knowledge about a restructure or insolvency, I think has really grown with sort of brokers and lenders, and particularly those sort of lenders who are looking at sort of a bit more of a niche position. So they sort of understand what a problem might be. They understand the options available to deal with that problem. And they understand that if they get the right, or the company gets the right sort of advisor or someone to help them through a process, and whatever that process might look like, that they can understand that on the other side of that process, you know, the company's in a much better position, and they're happy to do that. Whereas the big banks just run scared. You know, they sort of look at it and it becomes a on this box here, you don't tick that one, so we're not even going to touch it. But if
Yeah.
you get somebody who kind of goes, oh, but I understand that that was a problem. I understand that you've done X, Y, and Z, and therefore on this side of that, whether it be a transaction or some other sort of operational sort of improvement stuff, it now looks better. And this is what it looks like. So yes, I'm absolutely happy to back you on that side of it.
I think some of the limitations of the big banks in terms of why that space has grown so much in that, you know, that sort of space that you're in, you know, there's you know, so the limitations around, you know, wanting security, right? So, you know, quite often the mainstream lenders, you know, with your banks, you know, it's all usually security based, right? So not always, but there's a big focus on, okay, what security do I have, right? And quite often that can limit the funding requirements, right? So
yeah. Guys, it's been an absolute pleasure. We've already got 3 questions in the chat box and we've only got 10 minutes to go. So to everyone else, please go out in the chat box now. Now's the time to hit Andrew and Maddie up with some questions. And I knew this question would come up and it came out in about 7 minutes of the start. Yeah. Fees. So I'm recapping this sort of question, but we do hear it a lot around fees in engaging someone like WCT and how that works from a client perspective. So I'll let you two decide who wants to ask the first one.
I might cover that one.
Big dog to do that.
Because our approach to fees is we undertake our advisory engagements on a fixed fee basis. And usually it's spread across 2 or 3 different stages. And we sort of scope out and say, well, look, you know, stage 1, as an example, is we need to undertake a due diligence. We need to understand your business. We need to understand, you know, the cash flow. We need to understand what your liabilities are. We also need to understand where risks are. Yeah, we're talking about personal guarantees, for example, or where are you at with your ATO lodgements? Are you likely to get a director penalty notice? So we will say, okay, for stage A, this is the fixed fee. It'll depend on size and complexity of the business, what industry it is. To, you know, is there someone else involved? You know, have you got a good accountant who can prepare cash flow forecasts really well? You know, and if that's the case, our cost is less because we can, you know, we get a level of comfort from the accountant involved. You know, who's the broker involved? What's their experience in the industry? Do they understand insolvency and restructuring? Okay, if they do, again, that means that there's less that we need to do, so the fee comes down again. Yeah, and then we say, well, this is what part A is. And the outcome of, say, part A will be a recommendation on strategy. And then from that recommendation, there's an implementation sort of stage. And again, that can be over a couple of different stages, depending what's involved. But it might be, okay, as part of this engagement, we're going to, you know, we're going to get some valuations around here. We're going to organize refinance of the family home, for example, because there's some equity locked away in that, but we're going to need access to that cash because we're going to do these steps here. So it's going to be step 1, do that, step 2, do that, step 3, do that. And our cost to assist with all of those things is going to be Y. So again, you know, it's kind of fairly clear as to what steps that we're going to provide, what the cost is. And we do things on a fixed fee because I suppose it's clear for everybody. You don't get in those situations which arise in the insolvency industry where if you're paid on an hourly rate, there is a tendency and certainly a suggestion that, well, you're going to spend a whole bunch of time on it and increase the fee.
And just on that fine, in terms of the finance aspect of it, in terms of the fixed fees, that obviously the ideal is to get, I suppose, payment up front. But yeah, sometimes depending on where you're at with the strategy and what stage you are, sometimes the finance can be part of that solution, right? Where you go, look, part of that finance can be set aside for, I suppose, for engaging us as part of some of the implementation side of things, right? Because having us in there and assisting in that regard.
Every restructure needs time and money, and some of those are, again, you might have, you know, if we're undertaking some kind of transaction, we're going to have legal fees for documentation. You're going to have an accountant, you know, again, if they're providing cash flow forecasts and information and doing lodgements and things like that, there's some cost towards that. So, you know, you got to put any fee in context of what you're trying to achieve and the parties that are involved in what particular aspect.
Yeah. So stage 1, basically what I'm hearing is it's really the fee is fixed. So there isn't that sort of floating and the ability to go, we think the fees are going to be X and then they end up at Y. And that's really based on the complexity and the size of the client. So, you know, a client who, you know, you might be looking at, you know, $1 million to $3 million versus someone in turnover versus someone who sits in the, you know, 10+ mil space is obviously going to require a lot of different work. And so the fee would be reflective of that. Is that
yeah, that's right. And somewhere we might come and say, look, for this first part, because, you know, it's something that we understand, or we've got some history, or alternatively, we've got quite a lot of confidence in the other people involved, the broker, the accountant, etc. We'll say, you know, it'll be 10 grand plus GST. Whereas some we've kind of gone, okay, I don't have a lot of confidence in your accountants, you know, in doing what we require. All they're going to, you know, all they do is say tax compliance. So they have got a skill set to build a cash flow forecast so we can run some different scenarios. So we're going to have to do that. So again, there's a cost for that. And you know, and again, it goes up complexity and what's going on and time limits and
you can break it into stages. Sometimes we break it into stages where you go, there's so much to think about. You go, well, how about we just focus on, instead of getting too far ahead, sometimes you can't get too far ahead. You go, let's just break it down. Let's just do this bite-sized piece here. And let's look at it, you know, and it might be, instead of being one stage, it might be 2 stages, part of that due diligence phase, right? So let's focus on the number 1 priority. And usually it comes down to what are the priorities as well. Oh, so.
Yeah. Hey, Maddie, on that too, which probably ties into the next question, is around how brokers can engage with you at WCT. So one of the questions is do you guys have a cheat sheet, and how do we engage with you? So I imagine that's sort of for them when they are at, you know, an appointment or they've been engaged by a client, they identify that there's going to be some issues and some support that may be required. So 1, do you have a cheat sheet? 2, how do they engage?
Look, yeah, we do have a bit of a cheat sheet for different applications. And look, I suppose, no, it's not one that we've, I suppose, developed specifically for brokers, but like it could definitely be adapted, and we can sort of look at putting something together in that regard. Right. So yeah, with that, and again, it's just about tailoring, I suppose, these things. We've got different cheat sheets for different industries, depending on who it is, whether it's the financier themselves, it's the broker, it's the client, it's an accountant. So yeah, definitely we haven't got one right now, but it wouldn't. We pretty much got it all there that we could adapt.
Well, you're being recorded, Maddie, so everyone's heard it here first. For everyone that's attended today, you will receive some cheat sheets in the coming weeks from Maddie. But yeah, how do they engage? How do they engage with you, Maddie? What do they need to do?
Oh, it's just a matter of, I suppose, you know, picking up the phone initially and having a chat, right? And just having a chat about the situation and, you know, how we can work collaboratively. Because really, at the end of the day, the reason they're giving us a call is because they've got a client where either they're facing some issues with getting the finance, right, that might require us to sort of give some advice around that, or it might be a situation where they've got a client, so we need to refer them a client. Again, it's just helping have a discussion about that. So really it comes down to pick up the phone, have a chat to sort of sort out, you know, whatever the issue is that might be preventing them getting finance, or what the right type of finance, right? Which might require a bit of assistance from us then to go and work, okay, what are the assets in the business? Because they might be asked to just say, I want to go and finance a car, right? You go, bang, there might be an opportunity there, or it might be not just an opportunity for the sake of getting finance, but there are other things in the business whereby, okay, it's no longer just a discussion about a car. This is more of a big picture discussion about your overall finance structure, right? Something like that. Because sometimes you've got to sort of think laterally to figure out what's the best solution that'll help the broker and also the client themselves. So,
love it. And I'll let you finish there, Matt, and then I'll go to you, Andrew, for sort of any passing thoughts or commentary. But, you know, we've had a couple of insolvency practitioners register for today, but, you know, the majority of our attendees today are brokers who obviously really care about their clients and want to be able to know where to go. And who to engage with. So what message would you leave the guys that are attending today?
I think it's about identifying those complicated situations and reaching out. And we're happy to have and most people, I suppose, in our industry are, but, you know, reach out, let's meet up, have a quick discussion about what the situation is, you know, understand it a little. Maybe we can give you some suggestions, yeah, without having to sort of go too far from there. And I think it's just important to understand that look at the viability, you know, asset values and things like that, or something that needs to be looked at. But realistically, if that business isn't viable, you know, you don't want to get too far down the track with the finance application, that maybe that needs to come on the other side of some sort of restructure or some sort of transaction.
Yeah, perfect. So big message there is just to engage, and Ray's just asked as we're leaving, and Matt, I can probably take this one for you, but you know, Ray's asked, are there any short courses for brokers that, you know, would help understand the world of insolvency? And you know, for me, I'm going, yes, let's do a module in the early pay scholarship program. That would be great on insolvency and giving them a little bit of a 101. But I also think it's really interesting that brokers do want to know. And so maybe that's something where, you know, I can do an intro to you and Ray, and you might be able to, you know, offer a half hour or 45 minute sort of team session or online session with anyone that's attended today, just to give them some of those basics on when they're starting to sit down with a client like that. Would you guys be happy for us to intro you to people who would like to do that?
Absolutely. We often run sort of insolvency 101 sort of courses for accountants. And again, it's more about sort of trying to educate some of their some more junior accountants, but also those who've just never experienced a client or insolvency in general. So we absolutely can adapt something, and maybe we can do another webinar if the interest is there around that. And there are a couple of good courses through some of the industry bodies to look at as well, but there's a fee to that, and there's a time commitment, and sometimes you've got to be a member to do them, et cetera, et cetera.
Perfect. That would appear to be all of the questions. As I said, I'll definitely get you in contact with Raj after this as well. Thank you all so much for attending today. I know that taking the time out of your day to attend these sessions, that you're all busy in resi land or commercial land, and that you're all just here to try and grow your knowledge base and assist your clients better. Andrew and Matt, it's an absolute pleasure. You know, we're very fortunate to have you based here in Queensland, but certainly I know your work is done nationally around the whole country. So we will share your details with everyone as well. So, you know, please, I can't stress enough to reach out to these two. They're super collaborative. They really believe in education, and they really would like you to be armed with some tools to know when and when not to engage someone like WCT, and how you can help your clients better. Thank you all so much for attending the webinar number 4. Bye, everyone. Have a great day. See ya.